Hello and welcome to each one of you for today's webinar. Thank you for taking time out and attending this webinar. My name is Vivian. I am head of the consultancy for Century Financial. I will be taking the session on technical analysis today. The topic, as you all know it, is trying to identify chat patterns that happens in the market. We're going to be discussing about how to identify these patterns. At the same time, we are also going to be looking at after you identify the chat patterns, how do you use those patterns to take advantage of the markets, but at the same time, using those patterns, we'll also know how to manage the risk, which is very, very, very important. A small disclaimer before I go ahead and start showing you all the presentation for today. Any recommendations or any sort of trade ideas that has been given on today's session is not a trade recommendation for you to take right away. It is for you to understand. It is for educational purpose only. If you are already trading and you want, if you feel the recommendation is good, I would still suggest you speak to your consultant before taking any kind of trades, because each one's objective for their particular account will be different from everybody else. So today's session is more to understand how the technical patterns work and how to identify them. Again, before I start off with the session, if you all have any queries, please feel free to continue chatting, and I will try my best in between to keep answering as many questions as possible. All right, so let's move forward. Identifying chat patterns. Now, chat patterns basically come under technical analysis. For those of you who are very new, there are two to three different types of analysis. An investor, a trader, excuse me, sorry, an investor or a trader does, depending on the objective that they have for their account, and depending on what time frame they're looking at, and also depending on what kind of instruments that they would be taking advantage of. When I say instruments, it could be stocks, it could be commodities, it could be currencies, and etc. Cryptos. Now, very, very basic definition between the difference between fundamental analysis and technical analysis. Just to give you an idea, let's say we take the stock Apple, which pretty much everybody knows. So Apple, every investor would like to hold some sort of Apple position at some point in time. So let's say you're an investor who's looking for making a return for minimum 2 to 3 years, on the maximum maybe even 5 to 10 years. On an average, most of them who look for a return for a long term will look to do gain some returns over 3 to 5 years, and of course, you really have a very long term plan. It can go up to 10 to 15 years. Now, let's say if you're looking for an objective of 3 to 5 years, you mainly do fundamental analysis. What do you do as fundamental analysis? First, you study about the company. What does Apple do? Is Apple a profitable company? Are their products good enough to sustain and be innovative for the next 5 years? Then you come down to their financials. You go through their quarter on quarter revenue, their earnings, their management, and you see how well they have been growing over the last couple of years. And if you see consistency in their revenue, you see consistency in their innovation in the products that they're bringing to the table, then Apple fundamentally would look as a good company to be invested in. However, do not put all your investments into one single security just because it is a very, very, very good deal to enter into. Always diversify, irrespective of how strong you feel the company is. So that comes under fundamental analysis. Of course, there is more in-depth analysis that you can do with the numbers on the financial statements that you get from in fundamental analysis. Now, on the other hand, technical analysis is somewhat different. Now, let's say there's a stock that's trading at $100, then probably like let's say the next week it goes to 120, then probably the following week it comes back to 100. Then you see later in the month again it goes back to 121. Then it comes back to 105. Now, these are levels this particular stock is trading in. So basically, it is forming a range. Now, after watching the stock price move, and you see the fundamentals of that particular stock is good, but you still see the price fluctuating between 120 and 105. irrespective of the time frame. Probably this happens between every month. It can happen every week. Keeping the timeline aside, you see a pattern that is happening. You see 120, the market goes up, it drops back down to 100. Now, every time it has come to 100, you always see it go back up. So now there is this pattern that is forming, and now this is the most simple form of understanding technical analysis. So you use the past historical data to identify price levels where a buyer could potentially be looking to buy and a seller would be looking to sell off the position. In this particular example, if this happens multiple times over the next 6 months, it is very evident. Every time it goes to 120, you sell, and every time it comes down towards 105 or 100, you buy. Right now, of course, the market is not always going to be in a range. The market keeps moving, and there are new ranges that get formed. But just to sum up what technical analysis is, you use the past historical price action to identify future opportunities. And in simple words, that's what you do in technical analysis. Now, of course, there are a lot of technical indicators that could give you other information. You get moving averages. You can look at complex indicators like an oscillator, like an RSI. RSI is the relative strength index. Basically, it shows you the strength in the market on the buy side or on the sell side. Then you can use moving averages, meaning you take an average of the last 100 days of how much the price, average price of that particular instrument is. So there are more than thousands of indicators that you can use to identify opportunities in the market. But for today, we are going to be looking at the patterns these charts make while the market is moving, and how can we identify these patterns and how do we take advantage of these patterns. Now let's move forward. Now that we've got an understanding of what technical analysis is, there are various different types of charts that you will find. One of the basic chart is a line chart. I'm sure all of us know how a line chart works. In this case, basically it represents the assets price movement on daily basis. You can change your time frame to even minute by minute basis. I will get into the charts and I will show you when what I'm talking about when I'm talking about the time frame. Now let's just say every day the market opens in the morning and then it closes in the night. So what the line chart does is it takes the closing price and the price continues for the next day's closing, and hence the line chart plots out its movement. If the price opened today at 100, tomorrow, let's say it closed at 100 today and it opens and it closes at 110 tomorrow, you see the line chart moving upward. Let's say day after tomorrow, it closes back at 110, you see the line chart from 110 coming back lower. So that's very basic. I'm sure all of you all know what line chart is. Just to make you all refresh memory on your line chart. Now coming to the other chart patterns, I mean other chartings that you can look at is the candlestick, which majorly a lot of people look at candlestick patterns because it gives you a little more detail about how the market is moving. Again, each candlestick represents a specific time frame. So in this example, you can see basically there's a green candle and there is a red candle. Pretty much it is self-explanatory, but for those of you all who are very new, how the candle forms is there is a body to the candle. There you will also see wicks. Wick meaning like a candle wick. Now, the body can be a small body, the body can be a big body, there could be a wick, there could not be a wick. All that depends on where the price opened. In this case, let's say the price opened at this spot and then it dropped. So the open price, open and close always forms your body. Okay, so that is the solid part of the candle. So open and close is your solid part of the body. Now, high and low. It opened here, it came as low as this. Okay, if it had to close here, then this particular area would have become a body, but it did not close here. It in fact went back to its open price and it has gone all the way as high as this and eventually closed somewhere over here. Now this formed the body and the wicks always forms the high and the low. Now this is very important to understand to get the foundations right. So now when we are identifying patterns, these wicks or this body is very, very important. How we use it, how we can identify those patterns. Once we understand this, we should be able to identify patterns easily. Now, vice versa for a red candle, it actually opened on a higher price and then it closed below. Let's say, for example, it opened at $100 a share. ABC company opens at $100, then it closes at 98. So it becomes a red candle because the open was higher and the close was lower. On the opposite side, the open was lower and the close was higher, and hence it has made a green candle. Green candle indicating price has moved up, red candle indicating the price has moved down. Now, I hope most of you all have got the basics set. If you all have any questions, please feel free to ask me. Now, moving forward, now using those line charts, using those candle patterns, what all can be identified in the markets? So, the most basic uh, and most widely used concept is your support and resistance. Remember the example that I gave you about the stock which went from 100 to 120, then again it came back to 100, and again eventually at some point in time it went towards 120, 21, came back towards 105. So now you see the pattern, right? It is going towards 120, something is resisting it from going higher. So that is known as your resistance. And every time it comes down towards 100 or 105, something is pushing it back upward, and hence it is known as support. So you always find supports at the bottom, you always find resistance at the top. Now, in this example, you can see this is just a random example of how a support and resistance looks. Now, of course, we'll be looking at this even in your live chart. So that way, when you're looking at a live chart, I can show you how the support and resistance are made. Um, so you see it went up, it came back down, takes support, goes back up. Now in this case, it is not coming back to the same level as previous. In fact, it is coming down and it is making a higher high, coming down and making a higher high while it is making a higher low. Okay, now I will come back to higher lows and higher highs as I'm explaining more in detail about how to find support and resistance over here. Just to understand how it works, how do you trade or how do you invest in a bounce? Buy when the price falls towards support. Again, take my example of the stock which moved from 100 to 120 and came back to 100 and 100, and again it went back to 120. Let's now we know 100 is a support, so you always buy when the price falls back to your support levels. Now sell when the prices reach towards your resistance, which is very evident that 120 was something it was not breaking. Now that is when you buy and sell on the bounce. But what about a break? What if it goes above 120? Now, for the very first time, this particular stock has gone above 120, and now it has opened room to probably go up much higher. So, that is what you do when you're trading on a break. So, when the resistance breaks, I will tell you how to identify or how to confirm before you take a buy. Sometimes it will break and it can always come back. So those are known as false breaks. Okay, but when it breaks, you can also wait for a confirmation before you take any trading decision or investment decision. However, irrespective of your support, if you're buying on support or resistance, or if you're buying on a break, yes, I've had question. I have couple of questions. Okay, is it on both sides? Yes, it is on both sides. It can also break below a support, meaning it can drop below 100 and it can go to 90. Now this is the first time it is breaking below 100. So at that point of time, what would you be your plan if you have bought it at 100? You always make sure you have kept a stop loss, because once it breaks, probably it can go to even 80. Now from 100 to 80 is a 20% down. Now, if that is a very big investment over there, you do not want to lose 20% on one single trade. However, if you have sectioned out only a portion of your investment into that particular stock, and if you are not very, very highly leveraged and you are willing to take the 20% hit, then I would still recommend keep a stop loss at 25%. It all depends on the risk management. Anything beyond what we see, you always need to keep some sort of risk management in place. I'll show you a couple of examples how to keep risk in control at all times. Excuse me. All right. So any percentage on support and resistance? Yes, we can also measure in percentages. I will show you how you can look at it in percentage in while I'm showing you the live chart. Now, I hope we've got the basics of line chart, candlesticks, and now, of course, the support and resistance. Now, support resistance basically up is the resistance, down is the support. That's easy to understand. Pretty much, this is an example over here, but earlier we saw on a line chart. This is on a candlestick pattern. Now, in this particular example, you can see this particular instrument, the price action, it goes up, it takes rejections and it drops back down. This is the second time it had gone up, or the third time rather, and it drops back down again. And we see the fourth time it goes up again from the same price, it has dropped back down. Fifth time, drop back down. Now, how do we know whether it is a support or a resistance? What if it happened only for the very first time? Again, taking my example of a stock which went from 100 to 120. Now, of course, if it is happening for the very first time, you will never know 120 is a resistance because that's the first time it is ever going to 120. But when it came back to 100 and the second time it goes to 120, you still watch the price and then you see it drop back down again from 120. So now this is the second time 120 is acting as resistance. Now the third time it happens, it takes a resistance and it drops back down. Now you know 120 is a solid resistance. Now a simple rule that you can follow is anytime a particular price action reverses from the same price or closer to the same price more than three times, you can take it as either a very strong resistance. In this case, this was a very strong resistance. You can see one, it came, second time it came down, third time it came, again it came back down. So you know this particular area is a resistance because you have three confirmations. So minimum three confirmations. You can wait for even a four or fifth confirmation, but if you wait for too long, probably you might miss out on the opportunity as well. So minimum three confirmation is what what generally traders look at. In this case, the third confirmation came down. So now the fourth time when it is coming on top, now you do not have to wait all the way for this price action to take the trade. You can always keep an order at this point in time and take a short position. For those of you who do not understand short position, do not worry. I will explain that as well. But in this case, basically, whoever had a buy can sell the profit, or whoever has not taken any position, they can short the market so that when the market comes back down, you make a profit. This is the fifth time it came back down, profit. Now, of course, on the chart, it looks easy. It looks like, every time it went up, I would have made a lot of money. It is not always the case. There are days when it goes back to these levels and it could directly shoot back up and it could go to a level where it might never come back. Again, giving you the example of a stock ABC, which went from 100 to 120, 100 to 120, 100 to 120. And the day, let's say, it has gone back to 120 the fourth time, or let's say it went back to 120 the sixth time, uh, or let's take the other way around for people to understand more easier. Every time it came down to 100, you kept buying because you saw it coming down multiple times. Now for the sixth time it has come back towards 100, 101, you decide to buy because now it has given you more than three confirmations. This is the sixth time it is coming, and let's say at that point of time it breaks below 100. Now it again enters into a territory which is unknown, and the downside could be at 80, the downside could be only at 98. We will never be able to gauge once it breaks out. Either you do a breakout trade or you put your stop loss in place. So, any trade recommendation or any strategy which has been profitable for how many ever number of times, risk management is the key that actually makes investments or trading successful. If risk management is missing, understanding all of these concepts would be of no use because one wrong trade with no risk management could also wipe away most of your equity. So, hence, I'm emphasizing on the risk management. Now, coming to the next. Now we saw support and resistance horizontally. We know every time it went up, there was resistance. Every time it came down, there was support. But then now we also know that the market is never going to trade between 100 and 120 for the rest of its life. Like that particular stock was just an example where I was trying to make you all understand the price moves between 100 and 120. Now, what if you're looking at a stock like Tesla? Right? Tesla keeps growing, Tesla keeps dropping, and it's not in the same range. It can go all over the place because Tesla is volatile. Let's look at Apple. Although Apple is much more stable, but Apple also moves, and Apple has not been in a price range. So this is where you identify trend lines. So trend is pretty much the same as support and resistance. When you identify every time the market comes back down, now instead of coming back down in my example of the stock ABC, which went from 100 to 120, now you identify the stock, let's say from 100 went to 120. The second time when it came back down, it came to 104, and then it went to 122. And the third time it came back down, it came to 106, and then it went back to 124. Now you see there is a higher low that it's making, and that is what forms the trend. So, in simple words, you understand that the buyers bought it in, then sellers took control. Again, the buyers came back in to push the prices back up in this particular example. Again, the sellers overtook them. Eventually, the buyers bought it back. Now, what is this particular price action showing me? That this particular instrument, irrespective of how many ever times it is coming back down, the buyers are dominating at most of the times. And especially when the buyers are buying it back even before it comes to the previous low as support. So this gives you a very clear signal that it is an uptrend. Same as what we did for support and resistance. You buy on support and you sell on resistance. Pretty much you do the same thing, but now your support and resistance, oops, sorry, your support and resistance are on the trend line. Now, how do we identify a trend line? All your lower points of this higher lows needs to connect with each other, meaning every time it comes down, it connects on this trend line as accurately as possible. Yes, there are places. Now this was a downtrend, you see it came down. This time, in this case, it did not touch, it dropped, then it went higher than this particular trend line. But the most number of connects, one, two, three, four. Now this forms my trend line. And the next time it comes up to probably these levels is where you put a stop loss again and take a short position if you're looking at a downtrend. But if you're looking at an uptrend, every time again, the simple rule is it needs to have minimum 3 points that touches. The fourth point onwards, you can start taking advantage of the market, provided you have a stop loss below. And this is your sideways ranging market. Now ranging market would be the most ideal and the most beautiful market for anybody, so that you can just keep buying on the buying at the bottom, selling at the top, buying at the bottom, selling at the top. Now this is something that you can't identify every single day, but there are more than 6,000 instruments that is there in the world. You can look at bonds, you can look at currencies, you can look at cryptos, you can look at equities. You have so many shares. So there are so many products. At some point in time, some product or the other could be trading in a range. Now, apart from that, you will also see it's not just a single product, or multiple products. Within a single product, you can trade on multiple time frames. You can trade on a 5 minute chart. You can trade on a 30-minute chart. You can trade on a weekly chart. You can trade on a monthly chart. So your opportunities are plenty, but identifying them and making sure the discipline is in place to take advantage of that move is the most crucial part to becoming a successful trader or an investor. Now, finally, I hope the basics or the foundation has been laid down. I hope it was clear so far for you all to understand support and resistance. Now, using support and resistance, now in this particular chat patterns, we are looking at line chart. So basically, all the red movement that you see over here is the price action on a line chart instead of a candlestick. So that's the only difference. If I convert this candle into a line chart, it will pretty much look the same. Okay, or if I convert this line chart into candles, you will see multiple candles, but it still makes the same shape. So do not worry about what type of chart we are looking at. What we are looking at is the pattern it makes. Now in this particular pattern, the first one is your symmetrical triangle. As the name suggests, The upside, there's a downtrend over here, meaning the price is going up, but it's not going up above the previous high. In fact, it is dropping, and it is dropping back before that, so it is making lower highs. In the meanwhile, we see the downside as well is not making a newer low. In fact, it is making a higher high. So when you find such patterns which fits into a symmetrical in terms of up and down, both these side, it is symmetrically positioned. Now, in most of the case, if this particular pattern appears on an uptrend, after a breakout, you will expect the pattern to continue. Meaning, once the breakout happens, you enter into a buy side of the market. Of course, I will show you where you can keep a stop loss on this, and this will give you a return. Now, more apart from your stop loss, the next crucial thing is what about your take profit? Now, we understand stop loss is crucial, but your take profit is also equivalently crucial, because let's say after this breaks out, you take a buy position and then it goes up a little, it comes back down, and the second time it tries going back up, and if you end up booking your profit too early, you might probably end up missing out on a very huge gain that could have potentially happened much later. So your risk reward has always needs to be measured at all times. Again, I will explain that to you later on in this session. Now, this is an ascending triangle. In an ascending triangle, you will always see the prices on the lows are always rising upward, whereas on the upside there is a strong resistance. So now what does this, it's like a story that you can see every time the sellers are pushing the prices down, the buyers are dominating by buying it back even before it comes to the low. That means the buyers are strong, however the sellers are still fighting back, and hence this resistance. In this case, once the breakout happens, once the breakout happens, now the buyers have been dominating and will continue to dominate, is what this particular pattern shows us. Now, this is a very interesting one. It is a head and shoulder, as you can see. These two are shoulder, but this is a reverse head and shoulder, or inverse head and shoulder. This on the upside is your normal head and shoulder. Basically, market went up, it came down. Basically, the market has been moving up, then it gives a drop. Again, it goes back up, it gives a drop. Now, can you see there are these 3 4 points that it makes where that forms your support? But on the other side, you will see this particular price action was quite high compared to these two. So when these two align together and in the middle the price action had spiked, it forms a head and shoulder pattern. Now again, although these patterns might look silly at this point of time, it is not. These patterns sometimes do work out in a really good risk reward ratio wise. And once it breaks below the neckline, so this is known as the shoulder on the left side, shoulder on the right side, and this is the head, and this particular blue line over here is the neck. So when the neckline is broken, you can expect the markets to drop, and vice versa on the reverse head and shoulder. Once the neckline is broken, you can expect the markets to go up. In this, how do you target how much can it go back up? You measure the length of between the neck and the head. Let's say the length between these two was 5%, for example. After it gives a break upside, you can expect it to go up by 4 to 5%. However, although it has given a breakout, you still keep a stop loss of 2%. So you're risking 2% to make a 5% gain, or you're risking 2% to make a 4% gain. Your risk reward is 1 is to 2. So always make sure you keep the risk reward. Now, this is a cup and handle pattern, which is pretty much, which looks like a cup and this looks like a handle. This I will probably show it to you all on the live chart, because it has few technicalities it needs to meet the criteria. And when you find such patterns, it is quite big. Again, in this case, once the breakout happens, once this breakout above this cup happens, you can expect the price to move up drastically, and the target will be the lowest point of the cup to this particular line over here. So let's say if this entire downtrend was from the high to the low was about 10%, you can expect a 10% upward movement, provided you still keep a stop loss of 2% on the lower end. Now your risk reward kind of has increased. You're risking 1 is to, you're risking 1, you're making 5 times more. So these can give you a good reward provided you hold on and wait for the take profit. But at the same time, very strict stop losses needs to be kept. And pretty much, I think rest of the patterns on this are self-explanatory. These are a lot of common patterns. It's a bull flag. Basically, the market has come up, it goes down. Where you saw this symmetrical triangle over here, the triangle is basically on a downtrend. Okay, it's making a descending triangle, or it could also be a rectangular but downward moving pattern. Now, this is known as a bull flag because bullish meaning the market is expected to go up. Bear flag is where you are expecting the market to come down. In this, it is a bull flag because the market came up, it made a flag, it looks like a flag, and once you get a breakout, you can expect the market to go up as high as this entire length it initially started off the rally. Of course, now I'm going to show you all of this on the chart so it makes it more easier for you to understand. I just want you all to understand the basics of how it is. Of course, now when I'm doing the live chart, you might get a much more clear picture. Now, if there is any specific instrument that you want me to look at or anything, you can write that as well in the chart. In this, for technical analysis, we do not need to have a specific instrument, but however, we can always check what patterns are forming on what time frame, on what instrument. We can always do that. So please feel free to ask some questions. Now, before I jump into the live charts, one indicator that I think you all should be aware of if you have not used it before is the average true range. Now, ATR is very, very simple to understand. ATR is what ATR does is it shows you, let's say, for example, you're trading gold. Okay, now if I look at a gold daily chart on a daily basis, I want to understand how much does gold move. Now I can manually look at the price movement and calculate. Instead of doing that, there is an indicator which is known as ATR. So what ATR does is it shows me how many dollars on an average can gold move in a day. Now, one thing to note over here, it does not tell you which direction it will move in. It will only tell you how many dollars it can move. So probably let's say if the average movement on gold is $10, we can expect gold to move anywhere between $8 to $10 even today because that has been the average for let's say for the last 50 days. So now when I'm taking a decision to do a daily trade or intraday trade, now gold is down by $10. So it has already moved $10 down for the day. So the most likely action that could happen is out of the $10 drop, probably the market could go back up by $5. Or let's say gold has opened and has not moved. Let's say yesterday gold moved up $10 and it closed probably $5 lower. And today again gold has opened and it has not moved neither down, neither up. You still have an opportunity to take advantage of a $10 move, provided you're on the right direction of the market. And that is where technical helps you, and ATR helps you how many dollars you can take advantage of. One more example I would put is let's say gold has already moved $8 on the upside, and now we know that gold is expected to go up, but it's only moved $8 for the day. Now you know you have $2 more remaining for you to take advantage of. Then you can decide whether it's worth getting into a trade after the price has already moved, or you wait for the prices to come back down and probably get into the market to take advantage of the continuation in the price movement. So ATR in simple words tells you how many dollars a particular instrument can move. Okay. Now if you all haven't used our platform, this is how the charting looks. You can go to technicals. In technical, you have overlays, you have studies. Like I had mentioned to you, we have a lot of technical indicators. Each one has its own USPs where it helps you identify different things for different reasons and different objectives. But of course, not every indicator is useful as well. It all depends on what your objective is. Now, coming to ATR, you click on studies and you get ATR over here. You click on ATR, it opens at the lower end over here. Now, in this case, we are looking at this particular instrument SPX 500. Okay, this is an old chart way earlier before the market had dropped. Now, at that point of time, we understand that SPX. Now, I'm looking at a monthly time frame, so I'm not looking at how many dollars SPX moves in a day. I'm looking at how many dollars SPX moves in a single month, and it is telling me it can move about $236. So that is what I can take advantage of for that particular month. And of course, now I'm going to show you how much it is moving even as of today. So it gives you a better indicating indicator in terms of what instrument moves how many dollars for what time frame. Before I jump into the charts, live charts. I would like to take this time just to tell you, if you like the webinar, if you have any suggestions for me, you can always write it on the chat. But at the same time, I would really appreciate if you can give us a review on Google. We would love to support you more. We would love to support you. Any suggestions that you have for the webinars, any specific topics that you have in mind, any recommendations that you have for me personally, please feel free to write it in the chat message so that I can take those feedback and help serve you better. And of course, your review on Google would be much appreciated. All right, now let's get into the exciting side of it, which is going to be the live charts. Just give me a moment. I'm just trying to switch over to my live screen. There's also a good question over here. Does ATR show price action or volume? Basically, it shows the price action most mainly, not the volume. Now, let's go through pretty much everything that we looked at it on the presentation. Now, let me start from the beginning. So, this is how the platform looks. If you've not used a platform before, you have your products, watch list, account. Do not worry, we can go through this another time. Let's focus on trying to look at the patterns. Now, let's choose something which pretty much all of us know, Apple. Okay, or we can choose gold as the commodity, or we can even choose crude oil. And I'm just going to be opening Apple. Now, by default, it opens on a daily time frame, meaning, I'll zoom this in. Each of these candles represent a daily move. So basically, this particular candle showed what happened on 17th of August. Let me make the font a little bigger. I think that would be more easier for you to see. Yeah. So on 17th of August, we see the price opened, the body is green, so that means the price opened lower at 172.70, or to be accurate, it opened at 172.81. It went as high as, if you can see, let me zoom this more. Yeah, it went as high as 176.414. It also made a low over here, but it opened here, but it has also closed at 170 4.62. So hence the solid body. Now each of these candles represents daily move. Now of course these are dojis, meaning it opened and closed pretty much almost at the same price. So each candlestick also has a story behind it, or it tells you a story of how strong a seller is in the market, or how strong a buyer is in the market. Now in this, pretty much it is very easy to understand. Yes, the buyers pushed it up, the sellers pushed it down. Ultimately, by the end of the day, both of them have come to a conclusion where they're not willing to buy more, or the sellers are not willing to sell more. So there's an indecision in this on this particular day. This was on 23rd of August. Pretty much the same here. Sellers pushed it down, buyers pushed it back up. Now here we can see a little more strength in the buyers coming back in, because now it is on the higher end, and this is today. Again, there's a fight between the buyers and sellers. So every technical has a story behind it. How you interpret it, it comes over time, years of experience, and each candlestick has certain pattern it makes. These kind of candlesticks basically is known as a dragonfly, right? So this is known as a dragonfly basically. It is going up, then you get shooting stars, you get dodges. So hammer looks something like this. It looks like a hammer which is pushing the prices back up. So hence the name hammer. But on the above side, it's the same candle had to form, with a long tail, with a small body on top. It is known as the shooting star. Now, each of these candles, once you understand them, it also helps you take a decision or helps you take a second confirmation for your trade. Now, we'll not get into candlestick patterns. We'll stick to the normal pattern of support and resistance. Now, before I get into more into support and resistance, I'll just give you another example. We look at daily candlesticks, right? These are daily movement. Now, let's look at what happens if I change it to a 10 second, or let's take a 10 second time frame. Now, every 10 seconds, there's a new candle that is going to be formed. Now, currently, this particular candle is forming. You can see it's going up. Basically, it closed higher, so it became a green candle. It opened here, now it is dropping. So, hence, it is a red candle. Now, let's see where this candle closes. So, basically, the candle closed lower than the open, hence the red candle. But you can see it had actually gone as low as this point here, right? Now, this is also a dragonfly which can go further up. All right. So, I hope in terms of understanding candlesticks, you've got the gist of it. Now, just to make you understand how why different time frame matters. Now, if I'm looking at 10 seconds of Apple, it actually is not going to help me a lot at all, even if I am the most short-term trader. So let's start with the daily chart. If I'm looking at a daily candle pattern, I'm trying to identify where can I buy or sell Apple for at least minimum 2 weeks to a month or even sometimes 2 months time frame. So my objective is more towards 1 month or 2 months time frame. But if I'm looking at a 30-minute candlestick, now I'm looking at an objective not for a month. Probably I'm looking for an objective of taking advantage of the market for the day, the maximum for the next 4 to 8 hours, right? Any time between next 30 minutes to next 4 to 8 hours. So the smaller the time frame, the faster we are looking to take advantage of the move. The longer the time frame. Now let's say I'm looking at a weekly candle pattern or time frame. Now when I'm looking at a weekly time frame, now I'm aiming for at least minimum 6 months to a year or two. So weekly time frame can give me a bigger picture. Now, if I go into a monthly time frame, now this could be a bigger picture. You can see from 2020, the prices ranging till here. So every month we've seen Apple move so much. Apple has also dropped historically in 2018. So now this is going to give me a very broad picture for if my objective is for next 5 years. Okay. Now, someone had asked me, can we measure in percentages? Yes, I will show you how we can measure in percentages. But now let's just look at support and resistance on Apple. Very simple analysis. Now we can see the price is going up. So that is very evident. Apple is going up. But has it given us some supports and resistance? Yes, it has. So if we take these points over here, I would rather do these because you get one, two, three confirmation. So the fourth and fifth time when it comes back down, I could jump onto this trade to be on the buy side for Apple. But however, in this case, it has broken below my uptrend. Hence, this particular trade would have been a lost trade. Okay. Now let's look at a few other supports and resistance. Now let's look at a little longer time frame. Let's look at a weekly chart. Okay. Now we saw the support has been broken, so that particular trade would have been a lost trade. But if I can look at a weekly chart, again connecting all my points over here. First point, my second point. This is my third point, which has breached, but it has come back below. Now this is showing me that Apple could still go back down because it is not able to go above this particular price range. So till it crosses above this, I would not recommend buying Apple if you're looking at it on a longer time frame. Now let's look at it on a 30-minute time frame. Now 30 minutes, we have a lot of action happening. Let's look at today. So basically, this was last evening. Over here, you can see there was. couple of times it has bounced back up. So probably if it comes back here during the day or next 2 days, this price would be a good level to buy because you can see the buyer dominating here. At this point of time over here, Apple is not showing us too much of an option. Let's look at SPX. SPX basically is the top 500 companies of US put into one basket. Basically, this also includes Apple in it. Now, let's look at SPX. Okay, SPX shows something interesting on a 4-hour chart. Let me break this down into a 30-minute chart. Now, if you look at SPX uh, on a 30-minute chart, again, we are looking at a 30-minute time frame. We see a resistance here. Now, this was the first time, second time, third time, fourth time. Now, probably if SPX comes back to 180 levels, it would be a good level to short the market. At the same time, we can see supports around these levels. It has come breached probably one, two, three support. Fourth time we took, it would have hit the stop loss and then went back up, but that's okay. Stop loss sometimes protects us if it never goes back up and continues going down. Okay. Now, basically, this how it looks on your charts. Let's add ATR to it for your take profit and stop loss. Oh, one thing I wanted to show you all also was let's look at how it looks on a line chart, right? So now line chart only has closing prices. It does not have the highs and the lows. So line chart will give you easy pattern recognition when you're trying to identify a head and shoulder, or if you're trying to identify a double top or a double bottom. There was a head and shoulder. Let me try and find a head and shoulder for you. Just to give you an example. Okay, so now this is a reverse head and shoulder, right? I hope you all can see it. Let me, yeah. So we see the price has been dropping. Okay, so how do you know that? You have your trend line. So price drops, drops, drops. So that means every time it goes up, it's dropping. That is one good confirmation there. Now we are on a downtrend. So once you confirmed your downtrend, now we see this pattern happen here. Spikes back up, makes a good low over here. Okay, so it made a good low here, makes another drop here. Now goes back to pretty much the same levels and drops here. Now at this point of time, of course, nobody knows it's a head and shoulder or if it is not. But by the time it breaks out, let's say about around this level over here, while it breaks out during this level, now it is a very clear pattern. If you remember, let me show you the head and shoulder here, right? So pretty much this is how it looks. Now in this case there are two ways you take advantage. This is your neckline, and your neckline does not always necessarily have to be a straight line. It can be slightly curved upward. You can also look at the shoulder is also curving a little on the higher end, so basically it's sloping head and shoulder. Once your neckline breaks, you take an action somewhere here or even a little higher because you want to confirm first. But let's say you're someone who have taken exactly on a breakout. You take a trade over here. Very important is to keep a stop loss. Now you can keep a stop loss under the shoulder, meaning if it breaks back down, of course, it is not a head and shoulder anymore. It has failed, and you take the stop loss and you exit. Now, take profit could be a percentage of this entire move. So you see over here, there was a move of almost, let me make the fonts bigger. Yeah. So there was, if you take the neckline, as I had explained earlier, when you want to look at your take profit, you need to understand how much take profit, because sometimes we might end up getting out early when probably it could have given you at least 5 times more the profit. We don't want to make that mistake because your risk reward is very, very crucial. So in this case, we see SPX has moved about $63. That is about 1.68%. So after you take a buy, that is after the breakout from the neck, you measure your $63 or about 1.7% on the upside. So This is your ideal target. So this is where your take profit is gonna be. Okay, now I'm looking at a 4 hour time frame. On a 4 hour time frame, I have identified a head and shoulder pattern. Now, one is all of these levels need to form, meaning one, two, three, four, five, 6 points has been formed. Once your sixth point is broken, that is where your signal for entry comes in. Now, if you had to take a trade, this is how your trade would have looked at. Let's say you have taken a trade of 10 units, which is worth $41,000. Of course, now there is only $10,000 in the account. We are taking an exposure of 41,000, that is leverage, which we highly recommend not to take ever if you do not understand leverage products. Leverage is a double-edged sword. It can make a lot of losses if it goes against you. Of course, it makes a lot of profit if it goes in your favor. But that is something I would recommend. Please understand before taking any action with leverage. Now let's look at our entry price. So entry price over here is roughly at 3812. 3812. Now we are taking a buy, so you can see the blue line here. Just for you to see the lines better, I'm going to change my color theme to dark. Yeah. So now this is more easier for you all to see. I'm guessing. Okay. Now I'm going to take a buy this blue line. Of course, we're not going to get exact buy at this price. Probably a little higher is something we can look at buying, or let's say on an average we got it at 3820. Now your stop loss first level is below your shoulder. Okay. Now let's say if the loss is too big and that is something that you're not willing to take, you can always keep your stop loss even below the neckline break. But I would not recommend that highly, because it is still very close to your entry point. So there could be chances it might just slip down a little bit and then bounce back up. The further it is, the better it is. Of course, we cannot keep a stop loss right at the bottom and say we are safe now. Now the stop loss, I mean, it won't make sense at that point of time. Take profit, of course, is based on the entire head over here, that is 1.6%. So you put a take profit of 1.6 or 1.7% on the upside. Now, in this case, your risk reward, if you look at it, you're risking about 450 to make about 550. Your risk reward is 1 is to 1. If I even move the stop loss a little higher, risk reward doesn't seem that great, but let's say you use your ATR. Let's say what the ATR is showing. Now, please remember, ATR shows you the average movement for the time frame chosen. We have chosen 4 hours over here. Okay, on 4 hours, my ATR says that it moves on that particular day. Let's see, at that particular time, it was moving about $34, and we've kept a take profit of $67, which I still feel is decent, because if you double in 2 days move, or in the 2 4 hour candlestick, you should be able to achieve a $70 move, because your average movement is about $35. However, more than that, the most important thing is your stop loss. Is it below or above the average movement? Yes, your stop loss is roughly about $40 away from the entry price. Now, in a case where you get your entry price at a much better price, then your stop loss could be moved a little lower, because your ATR is showing at that point of time $34. If you want to be a little more safer, you can always keep a $50, sorry, a $40, $45 or $50 stop loss, but also make sure your risk was worth taking when you're keeping your take profit. If it is not, then it would not make too much of sense risking 1 is to 1. This is how you do your stop loss and take profit, using either the pattern to identify your take profit or stop loss, or you use your ATR to understand where you want to keep your stop loss and take profit. Yes, I have a feedback saying it's not a good risk reward. Yes, it is not a good risk reward, but at the same time, This is just one of the example. There are times where you can get a risk reward of 1 is to 3 or 1 is to 4. In certain cases, you might even get 1 is to 5, 1 is to 6. Now, not everything is going to be in favor of us where we can get 1 is to 2 minimum. Okay, if 1 is to 1 is something that is not worth taking, we can always look at another instrument. So hence, I was telling it's not just because I'm looking at Apple, I need to get trades on Apple. We have more than thousands of instruments to trade from. There are about 12,000 instruments on this particular platform itself for you to go identify and get, which is giving you a good risk reward. And minimum at least 1 is to 2 is something that we can look at. Anything above 1 is to 2 is even better. One simple discipline that I would recommend to follow is once you have identified a trade, once you have set your take profit, and once you set your stop loss, you do not turn back on what you have decided. In this case, let's say I have taken a trade over here, I've kept a stop loss of $350, take profit of $840, right? Now, once I take this trade, there is no going back on this because your trade is based on a logic, and this particular logic either is going to work out and give you this $800 profit, or if it fails, you're going to take a risk of $350 and you move on to your next opportunity. Most common mistakes a lot of people do is try to shift stop losses lower if the pattern is failing, which is bad. Sorry, my buy price got moved. They keep moving and eventually you remove the stop loss, which is the most dangerous because let's say a trade was taken somewhere here and then the market continued dropping. Now the risk is going to be limitless. So always stick to the basics of the discipline for risk reward, and of course your patterns, something you will learn over time to identify if you have not been trading or using technical analysis. Now, to make all of our life more easier, the platform itself has a pattern recognition tool. Okay, we have another 2 to 3 minutes. I will just show you how this works. Of course, we can again meet one on one if you want, or if you want your consultant to give you more in depth analysis. What we covered today was just more of the foundation. If you want more in-depth training, of course you can get in touch with your assigned consultant and sit with them one-on-one and learn more in deep all the patterns that is available and all the technical tools that are available. Now very quickly, I'm just going to show what the platform also offers. Now if you do not have the time, you have your consultant who will identify patterns for you and notify you whenever there's a potential pattern. But at the same time, if you want to follow a system that can identify for you, we have that in place. Now in this case, let me close this, I'm going to click on pattern scanner. There is breakout patterns and there is emerging patterns. Remember in the first few slides I said there is a breakout trade that you can do, or you can do trade on support and resistance. So in this case, breakout patterns is what we are looking at. Emerging patterns are patterns that are happening, like the head and shoulder isn't happening but it's not yet happened, and meaning the head and shoulder has, the neckline has not yet broken out, so hence you do not do a trade, but you can keep an eye on it. Breakout patterns is something that you can take action on. Now, if I click on breakout patterns, now these also have different time frame. You can choose what type of pattern you want. You want head and shoulders, you choose your head and shoulders. Okay. You want double bottom every time it makes a double bottom price action, you'll get an indication. Of course, triangle, wedge, channel, all the patterns that we saw earlier. Now, this is your head and shoulder. There is also cup and handle. There are few more which you can get on your live account. Okay. Now, asset classes. Do I want commodities, currencies, indices, shares, treasuries? For now, I've just chosen everything. Interval. What kind of interval? Do I want to trade on a 15-minute time frame, 1 hour, 4 hours, 1 day? You can choose that. So I've chosen everything for now. And this is what has come. Over here, if you want to filter by interval, you click, it can filter by interval. Okay, these are all 15 minutes trade. Then if you go lower, it will go to 1 hour trade, and if you keep going lower, it will change. Now I've reversed it. These are daily trades, okay, and trend. Now let's remove stocks. Stocks are going to be a lot. Let's just keep it simple. These are indices, currencies, okay. Now if you're looking for something with a bearish trend, let's say your view for the day is bearish and you're looking for an opportunity on the bearish side of the market. Again, view depends on person to person and time frame to time frame. In this case, let's say I am looking at okay, Nasdaq right now has come up for the day, but overall the last couple of days it has been dropping. On a 1 hour time frame, it is showing me a bearish signal. Now the most important thing over here is the number of stars. 5 star is a very strong signal. 4 star is still a good signal. 3 star is something you could avoid taking. 2 star and 1 star is something you could avoid completely. Now let's look at something that is giving us 5 star signal, meaning which is more stronger, more probability of that happening or going in your favor. Now let's look at, let me remove currencies also. Indices and commodities should do for now. Okay, now we can see there is a bearish signal on 4-hour chart. Let's look at something on a smaller time frame. Sweden daily. Okay, let's look at this 4-hour chart. It is telling me it is a bearish signal. That means the prices can go down. I think bearish would confuse people who do not understand short selling. Let's look at bullish. In this case, it is showing this particular thing can go up. It has formed a triangle pattern. It has also formed a double bottom pattern, and both have given me a 5 rating. Now, if I can click on this instrument directly or on the stars, I usually click on the stars. The chart opens up for you. And in this case, you do not have to identify the pattern manually, the system does it for you. What the system has told you is it has made a symmetrical triangle and a bullish pattern, right? That was the information that we saw here as well. You'll see the same information over here. Now, this was the breakout. Very quickly, I will show you how this trade works out. So now you know this pattern is in formation, and we also know once the breakout happens, the prices can move up. So in this case, you take a buy position once the breakout happens. You keep your stop loss, you keep your take profit. Now take profit is very simple. It has given you the take profit on its own. Okay. Now that's about 183 points as your take profit. So you have to keep minimum 90 points on the lower end. Sorry, about 67 points as your take profit, and you keep a stop loss of minimum 30. Now, when you keep a 30-point stop loss and a 60-point take profit, your risk reward is good. But in this case, I think we can afford to keep our stop loss a little smaller as well. So, 20-point stop loss and almost a 70-point take profit. Now, this is a good risk reward ratio. Let's say I do 100 units. Oh, sorry, let's say I do 10 units, which is about $36,000 investment on a $10,000 account. Again, please be careful with leverage. If you don't want to leverage, you can just do directly $10,000. You put $10,000, your risk is $55, your reward is almost $200. Now, this is a great risk reward ratio trade that you can take. Okay, so in conclusion, there are a lot of patterns, there are a lot of learnings that you can do, master certain patterns. You can wait for only certain patterns to form, only take decisions on those patterns. You don't always have to jump into every pattern that you see. However, if you'd like to take advantage of it, or if you want to monitor, if you want to take trades, you have the system that can scan the pattern for you. Although the system gives you the recognition on its own, I would still highly recommend initially to learn the pattern yourself, to identify it yourself, to take decisions on those patterns yourself, and then start depending on the system, because the system is eventually created by a human. So you can always customize your patterns. So now this is what this system does. You can always make a quantitative analysis using a lot of data. Basically, all of these patterns are formed on the price action, the price that has come here, the price has that has gone here. You can set up your own customized or optimized trade based on the patterns that you're going to identify. So there's a lot of things that you can do using technical analysis or the technical tools to optimize good risk reward rates for yourself. I hope most of what I've covered today was easy for you all to understand. I hope this has added more value and added more knowledge if you've already been trading. If you all have more queries, please get in touch with your relationship managers. And of course, you can be in touch with your consultants once your account is opened, and your consultant will always be by your side to help you out. If you're very new to trading, he will help you out right from the start, from A to Z, to understand the markets, to understand the products, to understand risk reward, to understand technical analysis, fundamental analysis, and pretty much everything there is to know before you start investing or trading. Thank you all again so much for your time, and I hope this session was useful. Please write in your comments if you have any feedbacks for me. Please do write it in. That is much appreciated. If you have any suggestions, if you have any topics that you want us to cover in the future, you can write it down here. Thank you all again so much, and hope to see you all in the next webinar, or of course in our office sometime, and get to meet you. All right, you all have a good evening, and we'll all meet again soon in the next webinar. Thank you.